Hi, everyone, and welcome back to another episode of Gee Whiz Weekends. I'm Emerald Fox.
I'm Lynette Zang.
And for those of you that are new to our channel and our show, each week I'm going to be bringing a social media post that I might have questions or concerns about and bringing them to Lynette so she can share her insights, her valuable insights, and any knowledge or opinions that she might have.
This is how you groom a protege so that we can transfer this knowledge. And we have a lot more things that are coming up that I'm really excited about. So I don't want to say anything too soon, but stay tuned because you're going to watch this woman develop as I transfer my knowledge to her. So I'm very excited for what's coming.
Yes. And also at the end of our show, we're going to be addressing one of your questions. So make sure that you keep sending those in to questions@LynetteZang.com, where I'm going to be going through those and bringing those directly to Lynette herself. But on top of that, we are also going to be addressing more questions from our viewers in our podcast. So make sure that you look wherever you find your podcast, Spotify, Apple Podcasts, what have you, and make sure to follow along so that you know when we're answering your questions.
Yep. And we're doing a lot of things on the podcast. So check us out. And let us know how you like it, or if you need something different. I mean, we can do anything we want.
We can.
It's fabulous. Okay, let's get to the question.
Let's jump in. So this week's post is from Financial Times. It says corporate defaults are at the highest rate since global financial crisis, says S&P. And the caption goes on to highlight that this year's global tally of corporate defaults stands at 29, the highest year-to-date count since the 36 recorded during the same period in 2009, according to the rating agency. And I have included a graph for you so that you can see that. My question is, what implications do these heightened defaults, hold for investors, financial markets, and, the broader economy?
Wow, that's a great question. And it's really loaded because we just recently talked about the debt wall that is maturing. And so what's happening is all of these corporations that loaded up on this cheap debt when they really couldn't afford it, and those zombie companies, which are companies that have not had enough cash flow to pay all the interest and forget any of the principal on their debt for 3 years, what the banks had been doing had been loaning them more money to pay that interest. And so their debt pile has gotten bigger and bigger and bigger. So when you see the highest level of defaults ever, what that tells me is that the banks can no longer afford to carry that risk on their books. And it now benefits them to let these corporations default because they're defaulting too. And I'm meaning the banks are, right? So, it's a really interesting thing that's happening right now in all of the markets, but it's indicative of the foundation crumbling, right? So if the financial markets are built on debt, and those debt instruments, bonds, that's what they're talking about, corporate debt, the bonds market, which you could be holding in your 401k or your IRA and ETFs and mutual funds. You don't necessarily know if you're trusting somebody else to position in on your behalf, like those institutional investors. What we've seen time and time again, and that's occurring right this second, is that the corporations are failing because the entire debt structure is failing. This is cataclysmic. And so now it's becoming visible. And that's really what's happening. It was happening before. Exactly. And so that actually has a knock-on effect of confidence as well. So for those that were counting on the income from those corporate bonds that are failing, well, guess what that means? That means less income. Right? But the bigger impact is the indication that it now is more beneficial for the banks who have already set aside a whole lot of money for loan losses, not enough, but a whole lot. And the other thing that we aren't seeing from this yet is what's happening in the derivative market. Those bets against the corporations. And it could be interest rate bets. It could be credit quality bets. It can be any kind of bet. And remember, it was 2005. I'm just thinking this through because I don't know what she's going to ask me before, nor do I want to know what she's going to ask me before, right? So just kind of thinking this through logically, it was, interestingly enough and coincidentally, in 2005 where they changed the bankruptcy laws and the holders of derivative contracts against a corporation of which the owners of the derivatives may have no direct link to that corporation other than the derivatives. But in a corporate bankruptcy, they go to the head of the line. They get paid out first. So you could be a vendor to that corporation. Yeah, interesting. And sell them a whole bunch of paper, for example, that they haven't paid you for, but the holder of the derivative contract is ahead of you. So they can suck all the wealth out of the corporation, and you, a legitimate vendor, could still end up with absolutely nothing.
Wow.
So,
yeah.
I mean, who reads these contracts? But if you're writing a contract, aren't you going to make that contract in your benefit for your best interest? Does anybody else really matter, typically? So, I mean, there are so many implications of these corporate defaults spiking. But the reality is they took on money that they should not have because they really couldn't afford it. But the lower interest rate made it look like they could afford more debt. And I mean, this is a phenomenon that's happening all over the world, to be honest with you. So yeah, the implications of corporate defaults, thank you, rising is really an indication of the crumbling financial system. Yeah, the foundation.
Wow.
That's what that is. Interesting. Yeah.
Well, I loved your answer to that, and just, indicative of the fact that you really don't know these questions that I'm going to ask, and then you being able to kind of piece that together with all of your knowledge. It just is a testament to you and
how old I am. And also, no, I mean, that's why, exactly. I used to think my grandfather lived to be 99, and I was amazed. He was born in 1875. And I was absolutely amazed at what he saw in his lifetime. Yeah. So, electricity in every home, the automobile, the telephone, all of these things and it used to blow my mind. But now that I'm going to be 70 this year, right? And I can look back on my long life with the technology, all of these changes happen a whole lot faster. And it's kind of mind-blowing. But you don't forget any of those instances. I was there in 1971 when the currency shifted from at least a quasi-gold-backed currency to a debt-based currency. And I'm seeing so many of the same kind of behaviors today around that transition. War, women's lib, civil unrest, energy crisis, on and on and on. These are all the patterns that repeat as we make these transitions. And I was also there on Black Monday, best day I could have ever been a stockbroker, right? Not even 1 year into it. And I had just gone off salary on October 1st. Oh. It was the single best day that I could have ever been a stockbroker because I know what that implosion looked like. I knew everything looked normal in the morning. Yeah. When I went out for lunch, when I got back, it was complete chaos. It was. The phones were ringing off the hooks. There were two, that was at Shearson, and they had two big sort of like waiting rooms with large TVs and quotrons, the quotes going across the bottom because people didn't have personal computers back in those days, right? And usually there would always be a handful of people there, maybe 6 or 12 or something like that. It was packed. You go in the back where all of the brokers' offices were, and when I tell you this is literal, they were under their desks. because they were too afraid to take phone calls.
Wow.
Best day I could have ever been a stockbroker, because I happen to have a client who owned a savings and loan in Crockett, Texas, for any of you Texans out there. Crockett, Texas. I really loved that man. But he owned a small savings and loan, and I had been doing treasuries for him, treasury bonds, and then writing calls against that. And all of his wildcatter, his oil wildcatter guys, which are very aggressive and certainly understood the markets and how they worked way more than I did at that point in time. They couldn't get a hold of any of their brokers either. And so he put me on what was called a squawk box in the middle of the conference table, and he had all of his friends around it. And they were like, what's happening with this? What's happening with this? What's happening with this? And then they became my clients.
Wow.
And
I love that.
Well, they are the ones that actually taught me how to read the technical language of the markets. 2.5-year training program at Shearson's. Why I went to them, because they had the best training program on the street. Never taught me how to read the technical language of the markets, because they didn't want me to know, right? They just wanted me to do what they told me to do and sell what they told me to sell. But I didn't ever think that's what people were paying me for. So I'm so grateful to those guys. And if you happen to be watching, thank you very much, because they all became my clients. And then we were trading, right? And they knew how to do this very aggressively. I mean, they're wildcatters. They're used to taking risk. And I just did what they told me, but I was learning and they were teaching me that whole time. It was fabulous.
Wow. An experience.
The reason why I think it's important to bring it up is because I'm smelling those overvaluations. And nobody at that point, that was 1987, right? That was really the start of the bull market. Nobody told me that was the start of the bull market. Never, ever discussed anything about that. But that is, of course, when they put in the plunge protection team and they put in all sorts of things. And that's what they do. They patch it, right? After the chickens have left the hen house, they close the door, but they make sure the foxes are still inside. So when they open those doors and the hens run in, the foxes get to eat. And I'm referring to the banks and the public in that. And the banks obviously are the foxes.
Right.
Okay, I'm sorry, I digressed a lot.
No, but it was wonderful and great to, get an example and a taste of your experience and your knowledge and where it stems from. I mean, that was such a huge day for you.
Oh,
and
I will never, I remember what I was wearing on that day.
Wow.
Yeah, that is, yes. Those are and that's, so yes, I'm very grateful to be as old as I am, to have that experience, because I was, when you go through a currency conversion, did I know that's what was happening? Of course not. And, my parents and my uncles and aunts and all of this, did they understand that? And they were pretty smart. I learned a lot from them. No, they didn't. This is critically important because they know how to make this transition and get everybody or most people to comply. Right? They want to keep things as normal as possible.
As quiet as possible.
Exactly. But creating all of this chaos so that you're distracted by this or you're distracted by that. And it's divide and conquer, right? So all of the wars and you're the bad guy and you're the bad guy, right? It's dividing so people stop talking to each other. And they've got somebody else to point a finger at and get angry at, or participate in this crisis or that crisis or the other crisis, so that you do not see how they are transitioning us into a new system. And they let that system run. So you think that you're making money, right? Like Bitcoin's a great example, because I think that Bitcoin was the Trojan horse. Introduced in January of 2009, quantitative easing introduced in March of 2009, right? Second run up for Bitcoin, completely in the system now. They've turned it into a new trading vehicle, because that's what it is. I mean, it's speculation. So really, but it gets people comfortable with cryptocurrencies, which then means that maybe the population will be comfortable with CBDCs. Right? When the banks did not, going back to your article, when the banks did not want you to understand how vulnerable they were, they just continued to loan those corporations money to make it look like everything is hunky-dory. But that is a disease that came from Japan, really, in the early 90s. I mean, Japan has shown the way to do quantitative easing and yield curve control. I mean, all of this alphabet soup of manipulations to make things appear okay. We should have a conversation about that another time.
We should.
Yeah. It's very interesting.
Yeah,
it's really interesting. And now the new central bank head actually raised interest rates to take them out of negative rates, right? Because negative rates, charging you to loan money, which makes no sense at all, does it? I saw the look on your face. You were like, wait, what? Okay, that is another video. We need to talk about negative rates. So, but, and maybe do that soon, because the Bank of Japan just went out of negative rates, right? Which has a lot of implications, but basically negative rates attack your principal. So you've gotten all the purchasing power left in the currency, right? Well, and you got to take more, and you can't do inflation because you've already inflated all of its value away. Then what do? You attack principal. And if you're paying, this is debt-based system, right? So if you, boy, we're digressing a lot today, but if you're actually paying somebody to loan them money, the central banks have decided that's a choice. Oh my God. Oh my God. But if you loan them $1, you're getting back 98 cents or 96 cents or not. Okay. I mean, really, who would you do that to if it wasn't your child? Right? I mean, that's the only person I would loan money to for negative rates, right? Or any rates at all. Yeah. Well, you need to ask me about that. We need to have a conversation about that. But we're kind of going a little long because we keep digressing today.
We'll go ahead and move into our viewer question of today.
Excellent.
And that is going to be from a viewer in the UK. His name is Chris, and this is regarding the CalPERS 40% reduction to retiree payouts. He says, "Dear Lynette, having learned of the massive $10 billion support loan entered into by CalPERS to bolster their remaining asset value of $20 billion, requiring such a massive devaluation of projected pension payouts, possibly occasioned by the collapse in bond and commercial property values, might the trustees be in a rock and a hard place when having had the option to invest in a small amount in gold might have mitigated this outrageous outcome?"
Actually, investing in gold would have mitigated that outrageous outcome. But I think we're going to see this in like all pensions, because we had 15 years of zero interest rate policy, right? And so buying all of that debt, it's all underwater, because as interest rates have gone, this all goes back. It's all the same issue. So the answer is yes, buying gold and having a true diversified portfolio. So you have your intangibles, but you got your tangibles. This goes down, this goes up, right? That is a properly diversified portfolio, but it's not just a problem of CalPERS. It is a problem of every single pension, every fixed rate annuity. That's all based on bonds, right? Exactly. Insurance companies. In fact, I'm just doing a piece on the insurance crisis that nobody sees, thanks to a wonderful viewer. That's a Yawa. Yes, the gold would have mitigated it. CalPERS, of course, is going to stay more, I can't say traditional, because stocks and bonds have only been around for a short period of time compared to gold, right? Gold is really the traditional wealth preservation asset. Exactly. But it doesn't really make, if you hold it, it doesn't make Wall Street money, right? So they want you to buy things, number one, to support their markets. And we've been watching that risk transfer. And by the way, that's really what's going to trigger the ultimate collapse like we were talking about, right? Once enough risk has been transferred from the few, so from the 1%, from the central banks, from the large corporations, okay, to the many, to the public, that is when it'll get too expensive for central banks to support these markets and make everything look okay. Right. That's when it'll be just the right level to let everything implode like 1987, but way worse, because that was the start of a bull market. This is a transition into a completely different system, which is even larger than the one that I lived through in 71, because that was a paper revolution. Now we're going into a full surveillance digital revolution. And that makes having real money outside the system that much more important, frankly.
Right. Wow.
Sorry if this was a long one.
It's great. And again, as always, we really appreciate that, your invaluable insights. They're amazing. And, what a beautiful experience you have. And yeah, we're really grateful.
Imagine you're going to have a beautiful experience too.
I'm looking forward to it. I mean, yeah, knowledge is important to us, our viewers, our family and our friends. So the more I can take, the more I can give and share. So.
Yep. And we have more of that coming up, don't we? We do. And I'm very excited about it.
Yes.
So, yeah.
Well, that's it for this week's Gee Whiz Weekends. We hope you enjoyed it. And if you did, make sure to give us a thumbs up. And if you have any comments, leave them below. Make sure to subscribe and hit that bell and follow along on our podcast and the rest of our YouTube channel.
Right. And let me ask you something, because of course you know more about all of this digital stuff than I do, right? And so if somebody wants to leave a comment, but they don't really have anything to say, they just want to help us help the algorithm, they can even just say hello, right?
Yeah.
And that'll make all the difference.
Absolutely. They can put an emoji in there, a thumbs up, whatever they want to say. You can leave anything. And the more traction we get, the more viewers we get, the more we're able to share with others.
So, exactly. And grow that channel, because that's what we got to do. Yeah, that's what we got to do.
Is helping others. So that's what we can do. Well, thanks so much, you guys. Remember, please stay safe out there. And until next time.
Bye-bye.